One that we haven't talked about is note-on-note financing.
Yes.
So a bank has a $50 million of commercial real estate on our book that we need to sell. So I got 7 loans. So Bill's private equity group basically calls up and says, Jack, I want to buy that off of you. Can we take a look at it? And you go look at it. And that $50 million on the books is really only worth 84 cents on the dollar. And I could kind of make it work at 84. So I'm going to offer you 84 cents on the dollar. A bank says, no way, man. I can't take an $8 million loss on this, right? But here's what we'll do. We'll take a $2 million loss. You put in 10 million and I'll give you $38 million of note on note financing. And so you take $50 million of not so strong CRE that's in delinquency, out of delinquency, in delinquency, out of delinquency, and you sell it to Bill. But you fund 50 million of that through $38 million C&I loan, commercial industrial loan. So that's what I would call loan laundering. You're laundering a bad CRE note off balance sheet, and then you're basically putting back on the balance sheet a $38 million performing C&I loan, but it's non-recourse. So what the bank would argue is, look, we got a $10 million capital buffer. So what we've done is we've changed our loan to value from 100 to 84, right? So there's a buffer. I struggle with this. Is why would you pay 96 cents on the dollar when you think it's only worth 84 cents a dollar? Well, it allows me to buy more with my capital stack. It's like, okay, that makes sense. Plus they have a longer time frame, right? So I get it. There's lots of good ways this could work, but a lot of these deals are non-recourse. So starting about 2.5 years ago, our note buying community, private equity groups, were saying, dude, we can't buy. No one wants to sell. Everything is moving to note on note. And then you start hearing this. And at first it was 70, 30, 80, 20. But then it became 90, 10. So the bank is funding 90%. And it's really $9 out of $10 is still exposed to commercial real estate, but it shows up on C&I. So I started reaching out to the regulators and I'm like, hey man, I'm sure I'm not the only guy seeing this. I'm probably just a voice in the chorus, right? But do you know that they're putting this stuff in? Yeah, C&I. And so there was a big push to move it into non-depository financial institutions reporting. So that's why you see these big run-ups is banks were having to reclassify from commercial and individual other into. So not only was there huge organic growth, there was reclassification growth. But I heard from 2 separate parties about 9 months ago that JP Morgan Chase was shopping a $300 million note in Chicago. And their negotiating started at 90-10. I'm like, what? So these are clients on the other side. I got clients that are banks. I got clients that buy it, right? So you can talk to both sides, and I sit in the hub of a wheel and I get educated by each sector of that wheel. Like, they started at 90, non-recourse. And I'm like, okay, but we know that property and we know that that tenant is only 60% occupied. In 2 years, it renegotiates and basically it's not going to be worth anything, right? But we turned it down. JP Morgan came back and said, we'll do 100%. You don't have to put any money in. So JP Morgan Chase, balance sheet JP Morgan Chase, basically is offering multiple people 100% note on. So basically, we're giving you money to take the stuff off our balance sheet so we don't have to report it.
And this is not a synthetic risk transfer. This is...
Well, that's a straight up a note on note financing. So bring up, if you would, let's go see, were they successful? So go to JP Morgan Chase, bring up bank reg data, go back to JP Morgan Chase.
Oh yeah, I got it.
Next to review Maine, scroll down. Woo, look at all those loans. Look at, delinquencies are getting better. Just ignore the orange chart. Mm-hmm. Click on CRE non-owner occupied, number 8.
Okay.
By the way, they seem to have a lot of red, right? So scroll down and let's go back and look at non-owner occupied. So the one right above it, non-owner. You see how that number goes from 1.2 billion and it drops 300 million in Q1. Any bets that that was a $300 million loan that got taken off the books?
And recycled into a non-depository
Correct.
financial institution.
Correct.
Okay, yeah,
Correct. So when you look at delinquencies going down, know that loan modifications is an enormous game changer on how you manage delinquencies. And we changed the rules to make it like an accelerant, right? We made it that much more powerful. But also understand there is a separate way of doing this, which is just give people money to take the stuff off your balance sheet, non-recourse. So in 2 years, it's entirely possible that that $300 million note will get thrown back over onto JP Morgan's balance sheet in 2027, Q1, Q2.
To be fair, it is, I guess, to have a dodgy loan on your book or to have a loan to an entity that then owns that dodgy loan, like Ares.
They don't own it. They're renting it.
Okay.
They're renting it. It's
well,
not
how long are these note-on-note financings?
I don't know. They could be across the board, right? So part of note-on-note financing is Bank A funds a private equity or a private buyer to buy assets off Bank A's balance sheet. And I've asked the FDIC and the regulators, hey, look, the NDFIs are great reporting. I like what we've done. But really what I care about is how much is it loan laundering, right? How much of those non-depository financial institution massive loan growth is banks paying or lending to people to take bad balance sheet assets off their own book temporarily. It's temporarily. Don't think that it's off the book. It's fine. It's non-recourse. It can get put right. And so I asked these clients of ours, how do you make money on this? And like basically JP Morgan Chase lends us $300 million at 3%. We're generating rental income that covers that spread and we make net interest margin. And we use some of that to as profit. Then when it turns sour and it has to get reevaluated back to normal market rates, we just give it back to JP Morgan. And we don't lose anything.
And would these private equity firms or private credit firms, would they, alternative asset managers, would they refer to this as bank capital relief transactions?
They all have names, right?
Yeah,
Synthetic risk transfers. But this is what I'm talking about. Look, there's a lot of very bright people trying to solve an overvaluation problem. The problem is, when have we ever solved an overvaluation problem in an asset class without some asset destruction? So if the asset destruction only comes, but now you see the cleverness of the loan mods. If we just kept dumping inventory and charging it off and repricing what commercial real estate, that property in Chicago that's $300 million is probably only worth 65 cents on the dollar. If you had to reevaluate that market price, every other bank has to now lower, and now the private equity groups are now, right? And so by extending and pretending it, by changing the rules and hiding what we report, not report, and by pushing it off balance sheet, it gives the illusion that things are better. So Bill Moreland, the 27-year-old collection manager at Wells and risk manager, say, there's no way in hell this is going to work, right? I'm more, dude, the Potemkin village just keeps getting bigger. And so I have a lot of bank clients, and I had 2 phone calls about a month ago. Hey, you're very negative. I'm like, I'm not the Pied Piper of doom. I'm just showing you numbers, man. I got kids that are trying to get jobs. I don't want a bad economy. But I also want my kids to be able to afford a house, right? And so we have overvaluation in asset class after asset class after asset class. Eventually, we're going to have value destruction. How do you have value? Well, we don't. We just keep changing the rules and changing how we do things to hide it. And so I've become, here's the curve of skepticism. No way in the world. Oh yeah, everything's great. Everything's awesome. I'm moving maybe a little bit more. Hey, I'm getting phone calls from chief risk officers and chief lending officers of 10, 12, $15 billion, very strong community banks. Go do business with your community bank. Do it. They're great. They're well run, not everyone, but there's a knock. It's the large banks that morph the rules. It isn't your local community bank. Your local community bank is going to probably be not problematic. But these community banks are saying, hey, commercial real estate's looking great. And I'm like, dude, are you aware of note-on-note financing? Are you aware of the loan modification rules? So when you look in your local markets, when they use bank reg data to get local market peers, they look at what their performance. Hey, Bill, all the guys that we do competition with in our local market, their CRE delinquencies are going down. We're thinking about lending more. No, this may work. Then you start coming to the realization it's the perception. It's the concept of wealth impact, right? If everyone thinks they're wealthy because their 401's up and their house is way up, they spend more. So if we can provide banks with that illusion, hey, delinquencies are starting to look pretty good, you should start lending more. Does it become self-fulfilling? Maybe. I'm not as dogmatic, and no way is this going to happen. I'm moving a little bit left, but I honestly believe that all we're doing is stretching out that runway. We should be in a recession. We should be. But if you just lower payments on enough people and you keep lending and pumping money into the economy, you can keep going on with the illusion. Liquidity raises all asset valuations. And that's the banks are now pushing this, right?
Thank you. Just close the door.